Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
Welcome to our series on analyzing self-employed income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. In this short tutorial, we'll discuss why K-1 income is difficult to understand and try and help to clear up K-1 confusion. We will start our discussion about K-1s by defining what this form is, who receives it, why we need to review it, and when we can use this income. We will then take a walk through the partnership and the corporation K-1s. Lastly, we'll discover the difference between ordinary income versus distributions. So, let's get started. Are you confused by terms like pass-through entities, ordinary income, distributions, or liquidity? Just know that you are not alone. In this session, we hope to break this down and simplify these concepts for you. Let's start with defining what is a Schedule K-1. A Schedule K-1 is an IRS form that reports the amounts that are passed through to each owner that has an interest in an entity. It is considered part of the borrower's personal tax return. Business owners use this form to report their share of business profits or losses to the IRS. K-1s can be received by business owners with an interest in a general, limited, or limited liability partnership, an S corporation, an LLC with 2 or more members, or an estate or trust. How will you know if your borrower receives a Schedule K-1? Your borrower's personal tax returns will give you a clue. All businesses that have issued a Schedule K-1 to your borrower will be listed on Schedule E, Part 2 of their personal 1040s. Looking at this Schedule E, we see that our borrower has been issued a K-1 from 3 different business entities. The Schedule E will also indicate what type of business your borrower's share of the income is coming from, with either a P for partnership returns or S for corporation returns. Remember that an LLC is not an entity that is recognized by the IRS, and as such is sometimes called a disregarded entity and therefore does not have its own IRS forms, and a multi-member LLC will file using either a partnership or an S-corp return. Both partnerships and S corporations are pass-through entities. The income is earned by the business, and then the owner's portion is reflected on the Schedule K-1. The business does not pay the taxes. The business owners are required to report their share of the income and pay the taxes at their individual tax rate. Let's start our tour by walking through Schedule K-1, Form 1065. Please note that IRS forms are identified on the upper left-hand corner so you can see that the income source is indicated as Form 1065. Part 1 is all about the business, the 9-digit EIN number, the name, and the address. Part 2 identifies the owner by Social Security or TIN number, name, and address. Part 2 also provides information as to the borrower's involvement in the business. Your borrower's ownership percentage will be the capital at the end of the year. Moving to the right-hand column, you will note 2 little boxes, confirmed that neither amended or final is checked. Part 3 is all about the earnings. Partnership earnings will be reported in lines 1 through 3. Guaranteed payments are next and will be allocated as per the partnership agreement. Distributions on Schedule K-1 Form 1065 will be found on line 19, coded as A as in Apple. Moving on now to look at Schedule K-1 IRS Form 1120S. Please note that in the upper left-hand corner, the source is indicated as an 1120S. Part 1 is all about the business, the 9-digit EIN number, the name, and the address. Part 2 identifies the borrower by Social Security or TIN number, name, and address. There is only one percentage sign on this form, and that will be your borrower's percentage of ownership. Moving to the right-hand column, you once again see those two little boxes. Confirm that neither final or amended is checked. Earnings will be reported in Part 3. Distributions on Schedule K-1 Form 1120S will be found on line 16, coded as D as in dog. The IRS does stipulate that an owner of a corporation can be considered an employee of the business. As such, they will not receive guaranteed payments, but they may receive additional income in the form of a W-2. Going back to those two little boxes at the top of Schedule K-1, why would the form be indicated as a final K-1? There are three possibilities. Maybe the borrower was bought out by business partners. Maybe that business closed completely and has been dissolved. In those instances, no income from this company can be used from qualifying. Lastly, the business could be moving into another business formation. When can K-1 income be used for qualifying? K-1 income can be used for qualifying if the borrower has accessed the income or the business has adequate liquidity to support the withdrawal of earnings. What's the difference between income earned and distributions? The distinction between income earned and distributions is a hard concept to understand. It's really the difference between earnings versus income received. Your self-employed borrower must report their earnings to the IRS. The owner's portion of the net income earned by the business is reported as ordinary income on Schedule K-1. Distributions occur when the business actually transfers cash or property to the owner. Your borrower does have some flexibility as to when they can pull the money out of the business. We know that ordinary income does not always equal distributions. Let me show you 5 possible scenarios that you may see on your borrower's K-1s. Some may look familiar, but some may seem odd. In scenario number 1, distributions are equal to ordinary income. Looking at box number 1 of the Schedule K-1, we see ordinary income of $25,000. And when we check for distributions, we note that box 19 shows distributions of the same amount, $25,000. We are good to go. Nothing further is needed because we know that the borrower has accessed the income and we can include the ordinary income in our income calculation. In scenario number 2, the distributions are less than the ordinary income. Looking at box number 1, ordinary income is $52,500. However, in box 16, the distributions are $30,000. Here, we have two options. In option number 1, if we need to use the total amount of ordinary income, we can document that the business has adequate liquidity to support the withdrawal of earnings. The second option would be to limit the amount of qualifying income to the amount supported by a history of accessing the income, or in our case, we could use $30,000. If we need to use all of the ordinary income, we would need to conduct a liquidity test by reviewing Schedule L of the business returns, which is the balance sheet at the end of the year. Our MGIC liquidity worksheet will guide you through what lines to review and will calculate both the current ratio and the quick ratio for you. In our case, both of the ratios are over 1, and therefore we have proven liquidity. We can proceed with using the entire ordinary income of $52,500. We will discuss liquidity in further detail in an upcoming video. In our next scenario number 3, the ordinary income is positive, but no distributions are indicated. Looking at box number 1 on the Schedule K-1, we see ordinary income of $32,000. However, box 16 shows no distributions, so we have a bit more work to do, as we have hit a detour. The K-1 has showed us that the borrower has not accessed the income, and therefore we must prove that the business has adequate liquidity to support the withdrawal of earnings. But when we turn to Schedule L to conduct the liquidity test, Schedule L is blank. Now what? This is a very common question because if the business does not have gross earnings of at least $250,000, it is not required to complete a Schedule L. Some alternative docs for completing a liquidity test would be to obtain a year-to-date balance sheet from the borrower or review several months of business bank statements and assess earnings versus expenses. Turning now to our next K-1 scenario. In scenario number 4, the distributions are higher than ordinary income. Looking at the K-1, box number 1 shows ordinary income of $25,000, but box 19 shows distributions of $52,000. How can this be? What are the reasons that distributions might be higher than ordinary income? First, there's a possibility that the business distributed money that was not earned, perhaps money infused by another source into the business asset account. Second, perhaps the borrower did not take a distribution in the previous year and is now receiving those earnings. Third, the business may have made more money but took advantage of write-offs, such as non-cash expenses. In our case, we looked at the K-1 from the previous year from this business, which helped us understand what happened. The 2022 Schedule K-1 for the business does show ordinary income, but does not show any distributions. This could help explain the higher distributions in 2023. It appears that the borrower retained earnings in the business in 2022, but then pulled them out in 2023. Most lenders with some documentation and explanation in the file would then proceed with the use of ordinary income in 2023. In our last scenario, the ordinary income is a negative $2,500, but there are distributions of $10,000. So no money was earned, but money was distributed. How can this be? This could be a result of non-cash distributions, or perhaps the business did make money but took some tax write-offs. We would need to look at the cash flow of the business to determine if that is the case. Looking at the cash flow analysis worksheet for the sample business, we see that ordinary income is a loss of $2,500. However, when it came to cash flowing the business from Form 1065, there was a non-cash expense in the form of depreciation of $22,500 that was added back in. The overall business income did support the distributions, but this does not mean that we are going to add in the 10,000 distributions to our qualifying income. We are only showing why the K-1 statement looks the way it does. In this example, we would need to deduct the $2,500 in losses from the income as shown above. When it comes to reviewing K-1s, the steps we will take are dependent on who our ultimate investor is. Will the loan be delivered to Fannie Mae or Freddie Mac? Because it may make a difference. A lot of folks are under the impression that when it comes to Freddie Mac, you get a pass when it comes to proving business liquidity. However, in Freddie's Selling Guide, Section 5304.1D, Business and Income Analysis, it indicates this is up to the lender's discretion, and the lender may determine additional review and analysis is required. So check with your investor and consult with your internal management on how they would like for you to proceed. As we make our way through the maze of different K-1 scenarios, remember that our concern is not to adhere to tax code or minimize taxable earnings. We are tasked with analyzing the stability of the borrower's income, and the source of the income is the business. Keep in mind, our end goal is to confirm that the business has positive earning trends, which will then help us to determine the viability of the business and give us the ability to estimate the potential for long-term earnings. After all, your borrower will be paying the mortgage payment from the money earned from the business into the future, and we want to do our best to set them up for success.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.